If you're over 40 and your dividend portfolio is still bleeding money despite those steady dividend checks, we need to talk. I'm about to show you the 4 hidden traps that are quietly destroying your retirement dreams. And most investors have no clue they're even caught in them. Look, I've been down this road before, so let me save you the headache. You did everything the experts told you. Saved your money, opened that brokerage account, and started buying dividend stocks from companies you recognized. Those dividend payments began trickling in, and you thought you were finally building that passive income machine. But here's what most people miss. Your account balance keeps shrinking even as those checks arrive. The math isn't adding up, and you're starting to wonder if dividend investing is just another Wall Street fairy tale. Here's what they don't tell you. There are 4 specific traps that transform the dream of dividend income into a wealth-destroying nightmare. Today, I'm breaking down each one using real data that most investors never see, plus the proven strategies to sidestep every single landmine. Let's dive into the numbers on the most dangerous trap first, what I call the yield mirage. You're scrolling through dividend stocks and, boom, there's a company paying 8% or 10%, maybe 15%. Your brain screams jackpot, but here's the data that'll change everything. According to historical market data, when dividend yields spike above 8% for non-REIT companies, there's typically a 70% chance of a dividend cut within 2 years. Think about it this way. If McDonald's suddenly started paying a 12% dividend, every institutional investor would pile in, driving the price up and the yield down. When you see these monster yields, the market is essentially voting no confidence on that company's future. I've made this mistake before, so let me save you the headache. That high yield you're chasing, it's usually the result of a stock price in free fall. You get the double whammy. First, your income gets slashed when they cut the dividend, then the stock price craters even further. Here's what most people miss. Sustainable dividend investing isn't about yield hunting, it's about cash flow detective work. The metric that matters is the payout ratio. What percentage of actual earnings they're paying out as dividends. Bottom line is this. Healthy companies typically maintain payout ratios between 40 and 60%. When you see ratios above 80%, that's a red flag. Above 100%, they're literally borrowing money to pay your dividend. That's unsustainable math, and the market will eventually correct it. The data tells a different story than what most dividend chasers believe. Focus on dividend safety first, yield second. The second wealth killer is what I call the diversification delusion, and it comes in 2 flavors, both equally dangerous. First, you've got the under-diversifiers. I see these portfolios constantly, 3 or 4 safe dividend stocks. Maybe it's JP Morgan, Verizon, and Coca-Cola. Feels solid, right? Wrong. When just one of those companies announces a dividend cut, you lose 25 to 30% of your income overnight. The flip side is the over-diversification trap. These folks own 100-plus dividend stocks, thinking they're bulletproof. But here's what they don't tell you. You've just created a complicated high-maintenance index fund that you can't possibly monitor properly. Let's dive into the numbers. Academic research suggests the optimal portfolio size for individual investors falls between 20 and 40 individual stocks. This gives you about 90% of the diversification benefit of owning the entire market, but you can still actually manage and monitor your holdings. But here's what most people miss about diversification. It's not just about quantity, it's about sector allocation. Over the long haul, you want exposure across different economic sectors. Think healthcare, technology, consumer staples, financials, utilities. I track this rule. No more than 20% of your dividend portfolio in any single sector. This way, if energy stocks get hammered, your healthcare and consumer staples can pick up the slack. Think about it this way. True diversification isn't owning everything, it's owning the right things in the right proportions. Here's trap number 3, and this one hurts because it feels so good in the moment. The income illusion. That dividend payment hits your account. Feels like free money, so you spend it. Maybe it covers a dinner out or helps with bills. Seems harmless, right? Here's the math that'll blow your mind. Let's say you invest $10,000 in a dividend stock yielding 4% with a 5% annual growth rate. If you spend those dividends every year, after 20 years, you'll have about $26,500. But if you reinvest those dividends, you are looking at over $46,000. That's nearly double the wealth just from letting those dividends buy more shares instead of spending them. This is compound growth in action. Your dividends buy more shares, which pay more dividends, which buy even more shares. It's a wealth-building snowball that gets bigger every year. The solution is dead simple. Set up a dividend reinvestment plan with your broker. One click, and every dividend automatically buys more shares, even fractional shares with zero commissions. I've made this mistake before, so let me save you the headache. That income you're spending today is stealing from your future self. Play the long game and let compounding do the heavy lifting. The final trap is one most investors ignore entirely, the tax trap, and it's quietly eating 20 to 30% of your returns. Here's what they don't tell you about dividend taxes. In the US, dividends get taxed two ways, qualified and ordinary. Ordinary dividends get hammered at your regular income tax rate. That could be 22 or 24, even 32% for higher earners. Qualified dividends, they get the preferred long-term capital gains treatment, typically 0, 15, or 20%, depending on your income bracket. For most investors, that's a massive difference. But here's the kicker. Certain investments like REITs and some funds pay non-qualified dividends that get taxed at the higher ordinary rates. If you're holding these in a taxable account, you're handing Uncle Sam a huge chunk of your profits. The data shows the solution clearly. Hold your dividend stocks in tax-advantaged accounts whenever possible. In a Roth IRA, those dividends grow completely tax-free. In a traditional 401k or IRA, you get tax-deferred growth, letting your compounding machine run at full speed. Bottom line is this: don't let taxes silently kill your wealth-building machine. Be strategic about where you hold these investments. So there you have it. The 4 dividend traps that keep investors poor, and more importantly, how to avoid every single one. Instead of chasing the yield mirage, you're going to focus on companies with sustainable payout ratios under 60%. Instead of falling for the diversification delusion, you're building a focused portfolio of 20 to 40 stocks across multiple sectors. Instead of spending that income illusion, you're setting up drips to harness the power of compound growth. And instead of paying the tax trap, you're using IRAs and 401ks to protect your returns. Look, building wealth with dividend stocks is one of the most proven strategies for long-term financial independence. But it requires discipline and knowing where the landmines are buried. Over the long haul, investors who avoid these 4 traps consistently outperform those who don't. The difference isn't luck, it's strategy. If this breakdown helps clarify your dividend strategy, please hit the like button to help other investors find this information. And subscribe for more data-driven investing content that cuts through the noise. Now, I'd like to hear from you. Which of these 4 traps caught you off guard? Drop a comment below and let me know your biggest takeaway. I read every single comment. Thanks for watching, and I'll see you in the next one.